All right, welcome back. Today we're doing another basic stock analysis, this time on Best Buy. They have a $32 billion market cap and are currently, as of, market close November 5th, we're selling at $129 a share. What's interesting is that like a month ago, I think they were close to $100 a share. So they've had a run up of 20-30% recently. So we're going to see, could that continue? Was that justified? I hope those are the questions we answer in this video. So I have a company description here if you want to read about them. I think everybody knows what they do, so I'm going to move on to the income statement. All right, first up is total revenue. All right, so we like to see this growing, especially recently, and I mean same pattern as all retail, right? We see the spikes in the holiday season. So like I said, we don't usually use revenue to get any metrics. We're going to use other stuff for that. All right, y'all know gross margin is very important to me, so we're going to look at that first. All right, so 25% on an absolute basis is kind of low, and then it's shrinking recently. So that's, I mean, obviously we don't like to see that, but we kind of know why. I mean, we're not surprised. You got Best Buy's facing huge competition from Amazon and other online suppliers, and they're just having to constantly cut costs and match prices to meet those guys. All right, let's go to pre-tax income. So pre-tax income is growing, which is good. I mean, look, the revenue was growing modestly. This is growing. It looks like it's growing faster than the revenue, and you're doing that with shrinking gross margins. That tells me that you're running more efficiently. That's a great sign. Really like seeing that. So we're going to get our valuation metric from, we got to kind of try to project what we think the pre-tax income is going to be. I'm going to lean on the conservative side and just take, look, the last 2 quarters have been 800 million. So I'm just going to do 800 million times 4. So 800 million is 0.8 billion times 4. $3.2 billion per quarter is what I'm going to say they're making. That's going to be what we use for our valuation as pre-tax income. All right. And then growth. So growth rate, like I always say, go peak to peak or pit to pit. Don't look at, don't look at this growth to that growth. You're going to get an inflated number and just don't do that. All right. So it looks like in about 5 year span, right? This is like 2015, 2016 to 2021. In a 5 year span, their peak went from 800 million a quarter to a billion a quarter. So that's going to be what we do. We do 1 billion divided by 0.8 billion. So 1.2 times in 5 years. So we raise that to the 1/5, and we get a growth rate of 4.5%, 4.5%. All right, let's go to earnings per share. Wow, this is great too. I mean, then this looks like it's almost on an exponential curve, so I really like seeing this. And yeah, that's great. All right, what we're going to do here is just get the last 4 trailing 12 months. So I'm just going to sum up the last 4 quarters. So I'm going to do this down here. It's going to be off screen, but I'll tell you what I get. So I'm going to get 980 for the last 4. So that's going to be our earnings per share. If you think it's going to be higher, obviously you can put in a different number here, but I'm just trying to keep it simple. All right, 980 for earnings per share. All right, so let's go to, now we're done with the income statement. I'd say it's a pretty solid income statement, and we're going to go to the balance sheet. So first thing we're going to look at is total tangible assets, and we're going to use this to get a pre-tax return on tangible assets. So what we're going to do here is take our pre-tax value of $3.2 billion, divide that by the current total tangible assets. So the current one, the most recent, is 17.3 billion. So 3.2 divided by 17.3, 18% on tangible assets. Forgot to put the T for tangible. 18.5%. That's great, especially for retail company. I mean, I know that we've seen some videos where we had companies making 3-5% on tangible assets. So I really like seeing 15% strong. So anyway, let's move to tangible equity per share. So what we're going to look at here is, this is kind of like the liquidation value of the company, that net worth. Like to see it growing, and recently it is. This is a little concerning, but I like that it's growing recently. So it's all right. Let's do a return on tangible equity. So what we're going to do here, since this is on a per share basis, we're going to do 980 because that's our earnings per share divided by this value, which is like 12.5. So divided by 12.4. Let's do 12.4. All right. So yeah, I mean, that's good. That's really good, 79%. But like I say, you always got to look at return on equity in conjunction with your price per book value, because those two kind of go together. So what premium is it selling for? So to get the price per book, we're going to do the current share price 129 divided by the net worth per share, or tangible equity per share, so 12.4, and we get 10. So your PB ratio is high, but that's kind of justified, I think, by the high ROE and the high ROA. So I'm not concerned with the balance sheet. I would definitely like to see better equity growth here, but I think that your return on equity and your return on assets kind of makes up for that. So it's kind of a wash for me. All right, let's move to the cash flow statement. All right, first thing we're going to look at is free cash flow, and this is going to be similar to our pre-tax income. We're going to try to project what we think it's going to be. I'm going to be more conservative, so I'm just going to say, so look, you follow in this line. Look at this huge quarter they had here. That's awesome. Like I said, I'm just going to take what is this right here? 700. So 700 million per quarter. So 0.7 billion times 4 is 2.8 billion a year is what I'm going to use for free cash flow. So 2.8 billion a year. Like I said, everybody can look at this graph and get a different chart. That's where your edge comes in investing. They say it's half science, half art. That's, the formulas are only the science part. All right, so now we're going to look at depreciation versus capex. So depreciation is how fast its assets are losing value, at least from a financial standpoint. So it looks like it's a little north of 200 million a year, and we're going to compare that to capex. So capex is the same in this case as purchase of PPE, which PPE means property, plant, and equipment. So I'll just show you real quick. So purchase of PPE, and then look at this graph compared to capex. See, no change. That's kind of how they classify all their purchase of new property, plant, and equipment as capex. So we're a little bit lower than depreciation, but pretty spot on. I mean, look, you're fluctuating between 150 and 200 million a quarter in capex, and then you're depreciating 200 million a quarter. So that's great. I like to see that. That means that you're reinvesting enough to keep up your assets, but we saw in the income statement and stuff, you're also growing. So you're growing your income without increased capital expenditures. So I really liked to see that. So that's a plus for me. And the last thing we're going to look at is dividends. Just check if they're paying them. Yep, that's great. So they're paying dividends and increasing their dividends. So an increasing dividend is a good sign, because companies are terrified of ever lowering their dividend. So that they know the market won't care if they just kind of keep their dividend the same, but if they ever lower it, the market freaks out. So a company that's increasing their dividends and increasing it consistently, looks like this is every year, that means that they're confident that they won't have to decrease it in the future. So that's really positive. I like to see that. All right, so let's go to valuation. All right, so first one, our rule of thumb method is going to be you take your pre-tax income. This is funny. It's going to work out exactly. Multiply by 10. So 32 billion is our new market cap, which you can see is like the exact market cap that it was selling at Friday. So I'm just going to put that. Funny how that worked out like that, huh? All right, so earnings per share one is next. So what we're going to do is 980 earnings per share times 8.5 plus 2 times our growth. So our growth was 4.5. Wow, 171. Very strong. I'm going to round up because it's 0.5. So 172. And then last one is going to be our discounted cash flow. All right, so we're going to take our cash flow at 2.8 billion a year. Perpetual growth rate. Remember, for perpetual growth rate, always use lower than your growth rate that you used in the other one. So I'm going to use 3%. And then discount rate, I'm going to discount at 15%. You can discount at whatever rate you want. I just prefer 15%. It's kind of like an opportunity cost for me. So what we get here is the net present value, and that's a $27 billion market cap. So 27 divided by the number of shares, so 0.246 billion or 246 million, and we get a share price of 110. All right, so we got 3 metrics. One's right on the money, one is pretty high, and then the other one's a little bit lower. So what do we do with this? I mean, I think this is not surprising. This is going to be something you run into a lot. This is where, I talked about the, science versus art part of investing, and this is kind of the intuitive part, which one do you feel better with? If you think that the pre-tax is growing and we used a little bit too conservative of a number there, I could see how that number would go up. If you think that our growth rate was too high at 4.5%, obviously our that middle valuation would go down. And then the free cash flow, I think we took a pretty conservative number there, and I always have a pretty harsh discount rate of 15%, so that kind of explains that. But all in all, I mean, look, this stock, I would say it's definitely, I would not call this overvalued. So it looks like we're at least in line with the market price, and there's a chance for potential growth. So I think it's definitely worth looking into. I'm going to be paying close attention to their earnings. I think it's Tuesday, and just go from there. I encourage everybody to do their own research. I'm not a financial advisor. I'm just trying to teach you how to do these so that you can do it with whatever company you want, and you can just continue to learn. So if you enjoyed the video, please like and subscribe. And if you have any comments, questions, or requests for other companies you want to see, please leave them below. Thank you.